We are live. Welcome to the show, ladies and gentlemen. We have a special edition for you, especially since the signs of the time. We're in the best of times, we're in the worst of times, and our guest today will help us understand. We're talking tokenization, startup liquidity. We have Anthony, Simone, we have Sander Andersen in the house. We are still waiting for Andrew Durgee. But in the meantime, why don't we kick it off with a gentleman that we do have, two in the hand, and let them introduce themselves, what they're doing in the space, before we get down to the meat and bones of how tokenization, security token, can really help startup unleash liquidity like never before, especially in today's day and age when the VC investments are down across the board, but particularly in the Web3 space. So tokenization offers a new avenue to capital raise for these companies. We'll learn all about that. But for now, let's hear it from Anthony. Why don't you tell us a little bit about yourself?
Sure. Thanks so much, David. Thanks for having me. So my name is Anthony Simone. I'm an attorney. I started out of law school in the financial services industry as a Series 7 registered rep with Merrill Lynch and then later Morgan Stanley. And parallel to my career as a financial advisor, I was also a securities attorney and worked with a firm in California for a period of 4 years, mainly doing arbitration work, but particularly working with know your client issues and different types of securities regulations. Someone eating a candy wrapper or something. So it's I've been in and around this space in the traditional sense, from securities and compliant offerings, both on the retail and then high net worth, mass affluent side of things. When I came to tokenization of assets, really blockchain and emergent technologies, started my own journey, looking at AI and looking at consulting and building out, automated processes for companies in my consulting role. But when I met my co-founder last January, Jeanette, she's had experience in the blockchain space since 2018 and was able to show me that the power of the technology beyond the headlines that I was reading in the news about different types of schemes and scams, et cetera. And so I've just been full on into the space and empowering small and medium-sized businesses with their capital needs and doing it in this new format, which has a lot of parallels to the way that things have been done, particularly in the US, traditionally for years. And so I look forward to highlighting some of that today.
Thank you, Anthony, and we'll get into the parallels. I think Andrew, Sander, we all, come from parallel industries, and that's what's beautiful about security tokens specifically, that it's not, it's just a continuation, but it's also a revolution in the way capital has been raised traditionally. Andrew, welcome to the show. In the interest of going in alphabetical order, why don't you, introduce yourself, tell us a little bit about yourself and your work in crypto, tokenization, capital raising.
Yeah, happy to be here. Hello, everyone. My name is Andrew. I'm head of Republic Crypto, engineer. I've been in the blockchain space for 13 and a half years or so now. I mined my first block back in February 2010. I was CEO and co-founder of a company called the Coin Tree, the first doing multi-sig security storage for Bitcoin, 2011, 2012, and 2013. In the hedge fund space after that, running due diligence and fundamental analysis engineering teams for hedge funds, most of which was crypto specific. Became a partner at a firm called TLDR Capital, which was the #1 ICO advisory firm globally, 2016, 17, and 18. Every major project ran through us back then. And then I joined Republic in early 2019 to build out what was meant to be the first vertically integrated crypto investment bank. We finished that full integration very, very early last year, and now we're going through a larger full-scale digital merchant bank, kind of emulsification and evolution, and our acquisition of INX is a really big piece of that. So super happy to be here. For those that aren't familiar with Republic, Republic is traditionally been three primary verticals. We're the largest private primary issuance platform in the world. No one's even close to us. We've done over 3,000 private issuances. Then we have Republic Capital, which is our venture and investment arm. We have it's an RIA. All of our funds and SPVs sit there, and that's not just crypto. It's all over the place. Do space and future tech and fintech, etc. They've got about $2 billion AUM there. And then there's Republic Crypto. So I built the Republic Crypto side. Got 6 or 7 products and services there. We're known for our advisory arm. We have a Web3 native track and an enterprise track. We're the largest token sale platform globally, one of the larger tokenization platforms. We have wallet products and treasury management products, and also fairly significant infrastructure provider, validators, nodes, etc. So really are fully integrated. It's a full stack service solution. We believe that's really the way that to move the space forward is to integrate as much of those processes and those services as possible. I think a lot of the fractionalization has been relatively problematic to get people on board. So if we can integrate more and more of the services so they can have a seamless experience, maybe even more similar to Web 2 that they've been familiar with, that will allow us to onboard more and more users. So we're just north of about 3.5 million KYC users on our platform, and growing and scaling. So yeah, happy to be here, and we love these topics.
Thank you, Andrew. It's always a pleasure to be in the presence of an OG. Sander, would you like to kick us off and end the round of introduction?
Of course. Hello, everyone. My name is Sander. I'm a serial entrepreneur, mainly focused on digital companies. My background is actually from sports, and that's also why I think I ended up in using tokenization for private market. It's all about performance, but also the collaborative way of working together in a much more efficient way there, where we have seen much more centralized entity has succeeded the last 20 years, which has made a lot of sense. But now with the new technology and what we have seen with crypto, I believe it's a new way of doing private market investing, and that's what we do at Finpeers. And yeah, I think I ended short there.
Thank you, gentlemen. I'm in the presence of legends, and it's exciting to speak to you all. I think we want to start our conversation from Andrew, and you mentioned let's kind of take it from the old world to the new and look forward. So Andrew, you mentioned Republic is one of the leading crowdfunding platforms in the world, and when we're talking about startups and how they can raise capital to fund their operation, there's traditional methods. Crowdfunding is one. You can go to a VC. You can go to Reg D, Reg S, other sort of primary raise avenues. So why is tokenization? What kind of added edge does it give over the Web 2 kind of TradFi model?
Yeah, I mean, a big part of that is just a kind of a faster path to liquidity and overall optimization of the cap table. When we look at the world now, we see less and less companies going public. We see most of the IPOs in the past 10 years have been not great and really just punished retail investors. And you're even seeing public companies going back private, Dell, Twitter, etc. And so when you kind of sit back and you look at that landscape, it doesn't look great for public offerings, and certainly doesn't look great for potentially liquidity for investors, with not having any form of public exit in the near-term horizon. And then we kind of look at Republic, and in particular Republic INX relationship, and it starts to look a little bit differently. There looks a lot like a very, very clear alternative platform or alternative track where you can come to Republic, we can do your primary issuance. We can provide the institutional custodial solutions and wallet products. And then we have the ability to move those tokenized assets onto INX and provide secondary market liquidity for the company, for their investors, for their employees. This is a drastically faster window to liquidity and a faster window for retail participation, which is a big goal for Republic. We want retail to have earlier access to these opportunities. There's a significant gating item around what's known as the accreditation system in the U.S., which prevents standard regular people from being able to participate in early stage upside of venture and early stage businesses. And now there's a framework and a path forward to not only allow that participation, but also be able to allow much faster horizons to liquidity and public pricing of a particular model or business. So for us, this is the next path where the interest has been insane. Obviously, we are the largest private issuance platform, and so we're a large origination vehicle. We're constantly being able to create inventory that we can feed into secondary market platform. And as you're starting to see the market kind of compress and change, in particular based off market conditions, looking at other options to be able to activate your community to participate within a fundraise is, I think, a fundamental change to the future of finance.
Thank you. So guys, when I'm asking questions, like it's not an interview, we want to slowly. So if you guys have anything to add on that, or specifically around the benefit, the added value of tokenization over traditional models, and I'll say for myself, like coming from the global south in South Africa and seeing the discrepancy in as you said, retail participation between the opportunities that I can access and the opportunities that accredited investors in the US could access. That's one of the things that really lit my fire in terms of Web3 digital assets, is really the ability for little old me over there in Africa to be able to get in early on these startups. Never mind that was in the ICO era where I wasn't actually taking any equity stake in the business and it was just all illusion. But now I think we've moved to a more mature phase where digital assets are representing real value in the companies in which that issue them. So maybe if you can speak to that, Sander, Anthony, to kind of from your experience, what is the added value of tokenization over the traditional model?
I believe that for especially early stage companies, having digital shares makes it much easier for accepting smaller tickets and invite more people in without increasing the amount of work you need to manage your cap table. I think that is a huge benefit, and we know that the big investors doesn't have time to impact your business directly, at least not day by day, but your early stage investors can be there, be your biggest supporter, and in that way you can actually I believe it's also a cheaper way of building businesses when you can do it together and everyone is benefiting from the business growing. So yeah.
Yeah, absolutely. In terms of reduced minimums to enter into investment vehicles that, as you mentioned, David, here in the U.S. have historically been reserved for accredited investors only, with high minimum entry points. And I want to add to that, in the traditional world, when we have a paper interest, so if you're a limited partner and you have your legal documents, the illiquidity comes in where if you wanted to sell that, it's where is the market for that, right? And so you have to find another, let's say, accredited investor that's willing to take over ownership of your interest and involve your lawyers. And it's a laborious process that's expensive and that's rather difficult. And so I think the advantage that a digital offering offers, a security token where you can build the parameters into the smart contract for as Sander mentioned, for cap table management, where announcements and distributions will go out in an automated way for easing the administrative burden. But also, should investors want to divest a portion or all of their holdings, now there's a much simpler process through secondary markets such as INX to potentially offload that. And we're seeing the building out of a robust secondary marketplace as we speak. So I think over the next 12 to 18 months, issuances that are happening now, that once they're out of their holding periods, typically a 12-month hold here in the US, we're going to see that portion of that coming in and providing some of that secondary market liquidity. So I think just very exciting times to come, and just the ease of transactions from a legal and ownership standpoint will be a definite game changer.
Definitely exciting times. And Anthony, I want to take it back to you for my next question. startup understand now the benefit of tokenization. What are some of the misconceptions or the barriers to entry for that you can help them kind of get beyond in order to take the next step and actually tokenize their equity or their revenue share? What kind of tips do you have for them?
Sure. Well, I'd say that there are many misconceptions because this is for many, it's a first time they've heard about it, or it's a brand new avenue of raising funds or issuing debt. That's maybe not a misconception, but maybe it is. You don't just have to raise capital via an equity offering. You can also do a debt issuance, and so that is something that we're working with an issuer now that is doing just that. There's no giving away of pieces of your company. There is the promise to repay, and that is another way to do it where you're not diluting yourself. And many founders are hesitant to do that and seek investors because of it. They're trying to seek funds through friends and family and just bootstrap and keep it going. But there are multiple ways to access capital that you need. I would say also, particularly in the U.S., there's this misconception that it's a very difficult environment to do what we're speaking about. Well, security tokens, or the traditional way of raising funds through private investors or issuing debt to private lenders, is something that's been well documented and approved and sanctioned by the government entities here in the U.S. And so there's no real difference other than some language in the offering documents, other than the fact that we're creating a digital share in your security token than the way that we've been doing things. So speaking with the right advisors, understanding that this is a process to do what is legally allowable in your jurisdiction, and finding the right jurisdiction for your offering, and then folks that know the process from start to finish. So I'll say this, as I mentioned to David before we started, I can probably speak for the whole hour on things that I've heard, misconceptions, but maybe I'll leave with this one, that it's there's with the Jobs Act here in the U.S., there's many different types of vehicles that you can raise capital through investors, and it's not only that accredited investor of the past. There's also Regulation Crowdfund, Regulation A+, which is a significantly larger crowdfunding type option, and you can reach out to your community investors, and whether they be accredited, non, or a combination of both. So I think working with advisors that can walk you through the process, through the legal process, and then recognizing that there's a marketing piece to this that I think that the gentlemen below are and yourself as well, David, are well aware of and support, because it's creating that community of investors that will help your raise be most successful, as well as future raises. Now there's investors that you can draw upon that have worked with you in the past. And so I think that is the idea, that this is a very involved process. It's not just flip the switch on tokenization and you'll get the funds you need. So that's working with the right professionals can get you there.
It's just important to note that what we're all talking about here isn't anything new from a regulatory standpoint. These are everything that's being discussed is built on 1930 securities law, and has well been stress tested. Now, inevitably, there are going to be some updates coming out to this, and we're following things like the markets bill in the House right now. But the process to go through this does not require any crazy additional hurdles or risks associated with it. This is just simply a more optimized version of being able to distribute equity in a digital format to those looking to participate in the business from a funding standpoint. So I think that's a really important item to note as people look into it, because they may feel that there's additional complexities around it, but actually what you end up doing is simplifying the process more, as managing the cap table going forward becomes much, much easier.
While we're on the topic of regulation, we have a great question from Ralph Horn from the audience. How do you see the implication of regulation being fractured at a global level with regard to tokenization? Please, he has a decency to say please. So we have to take this question. And it's super important because, you mentioned the Jobs Act, that you put out MICA, you have places like Jersey and Caymans and Bahamas that are known to be a little bit more relaxed with their regulations. So, how do you see, and any one of you could really take this question, how do you see the fractured, the state of regulation, the digital asset space being really piecemeal globally? I mean, it's true for a lot of areas, AI as well, but that's obviously not the scope of our discussion. But in terms of digital assets, what's the implications of really the piecemeal type regulatory environment around the world?
Yeah, I can jump into that mainly because Republic's working or writing a lot of the regulatory frameworks. It's a big part of our business model. In fact, the Korean regulators are in our office in New York today. And we're super active on the markets bill. We're involved in MICA. I'm in London, actually, at our London office right now. And obviously the bill we have rolling through just ran through the House of Lords here. Inevitably, there's going to be a fractionalized aspect to regulatory frameworks going forward, just like there is in other types of finance. Now, traditionally, U.S. has been kind of the gold standard for traditional securities and equities. The U.S. has been a little bit slow to get out of the gate as it relates to the updating their approach and view on digital assets. We saw some people come out of the gate really first, groups out of MAS, which is in Singapore, ADGM, which is Abu Dhabi Global Markets. You have VARA out of Dubai, MICA in Europe. But the big one I think to keep a really close eye on is definitely the digital assets frameworks coming out of the UK. And that's going to most likely come out much, much sooner than the US side. And that's going to be a problem for the US bill inevitably, because London is a financial hub already. And the bill that they're moving forward is extremely robust and a very holistic approach to the industry, and isn't necessarily hampering. It's just creating more clear frameworks for people to build upon. London's also heavily connected to other areas globally, extremely connected to the Middle East, extremely connected to China through Hong Kong. Due to British colonialism, they have a footprint in a lot of different places, and a lot of the financial infrastructure of a lot of those markets, which were emerging markets many, many years ago, but now are stable names, are just still directly connected to London infrastructure. So when that bill goes live, most likely that will be pole position. Whether the U.S. bill has the ability to override it, highly unlikely. When we're talking with Congress, and I've been fortunate enough to testify in front of Congress regarding this, and we work really closely with Congress on this now, we consistently emphasize the fact that however we roll out frameworks in the United States, it needs to very much take other jurisdictions into consideration, so that when that does roll out, it's not friction forward with other international jurisdictions that are tier A financial markets. It has to be able to integrate. Otherwise, you'll just find yourself in a very similar situation where we're unnecessarily ostracizing ourselves from the rest of the digital finance world globally.
Great. So before we go to the next question for Sander, anyone else want to touch on that? I know the word jurisdictional arbitrage is a little, tongue twister that kind of comes up a little bit in the crypto space. So that's something that, I think speaks to the risk, the fears, the complexity of having regulation united. But it's very encouraging to hear, from the main players that you guys are working with the regulators, and you're really trying to align it globally so that it can, regulation should empower, not hinder innovation. So that's definitely encouraging. And Sander, I want to take the next question to you, go back to, I think talking about the market participants and, the benefits of tokenization. We've had a lot of emphasis here on the retail side, on smaller ticket sizes, on retail participation, liquidity for. What about the institutions? What does tokenization, offer them? Why should they be excited about that? Private equity funds that you work with, the VCs, and which side of the coin would you say is more exciting to you personally? The retail side, the institutional side, both is also a good answer. Yeah.
That's just quickly the best jurisdictional arbitrage that has ever been in the industry was something called the kimchi premium, which is the ability to trade assets. If you had the ability to trade assets in the borders of Korea, if you could move money in and out of Korea in an effective legal format, you were able to really churn a pretty good profit for like a year and a half because of the kimchi premium.
There was a art in South Africa as well. We call it the biltong premium. It was a nice 5-8%. And the thing with South Africa is that you can only take out of the country 1 million rand, which is about $50,000, $60,000. That's really nothing. And if you get a special permit, you can increase your allocation to 10 million rand. So people would get their allocation, would get that permit, and then there's special exchanges in South Africa whose whole business model is revolved around running the art for people. So buying on Kraken, moving it to South Africa, selling, sending the money offshore, and keep cycling that. And I think it still exists. I don't know why the kimchi premium exists. The South African premium, the biltong premium, is definitely because of the the unrest. Zimbabwe, the premium was 30-40%, but to get Zim dollars is a whole out of the country. That's a whole different. That's like James Bond level complexity. So it's definitely remember those days, those market inefficiencies, and it seems like for better or worse, they're disappearing from the face of the earth.
Yeah, so if I'm most excited about the retail push or institutional push, I think I will say both, because when they can when both sides can see the benefits of working together, I think then we will see a much more efficient and fairer financial market. But we have briefly touched into it when it comes to institutions. I think they have looked at it as a very high risk step to take. Looking into tokenization and blockchain has, from a media perspective, seems very risky, but I think that's where we will see the most efficiency improvements, because in those markets, if they can standardize a lot of the buying, selling, and trading of privately held assets, that's where they can save a lot of money, and I think they will move lots of money into the blockchain as soon as they realize this is legal, it's working, and it's actually much more efficient than the old school lawyer and banker system we have today. And I think I come back to community again. Like, institutions has the money, but the retail has the power of sharing on social media, and more of the activity and the success of companies is dependent on their digital strategy, and that's where your community or retail investors can really change your business case. So I will say both, and programmable ownership, which tokenization really is the future, because you can incentivize so many stakeholders into your business project that you can, if you do it, you have huge competitive advantage compared to those that use the old school system.
So you mentioned the word programmable ownership, and I want to double click on that. DeFi, is probably the most advanced use case manifestation of this programmable ownership. You have all these DeFi platforms for staking, for yield farming, automated market makers that allow you to trade without an order book. Can we see that? Are we going to see that coming into the tokenization space and benefiting startups in some way? Are we going to see the programmable ownership of tokenization take that next step and integrate some of those DeFi primitives into the business model?
I believe private credit can be quite big, in DeFi protocols as long as you solve the voting challenge on how do you actually issue the private credit to the big institutions. If normal people can give loans to the big institutionals, I believe that could be a very, very interesting and cool DeFi platform.
Yeah, I think kind of jumping back and then coming to this, first to say any offering documents, pledging securities, et cetera. I mean, that is where, we want to make sure in all of your offering information, all of your advertisements, all of your marketing, that you run that through your compliance people, because any type of offer, any type of derivative or use of securities, particularly in the US, that's where jurisdiction I'm in, that's where I speak from, will be scrutinized. And so I think that we will see this evolution of more of this capital moving, particularly into the secondary markets. Once it's there, then folks will have the ability, like they do currently with some of the ownership of some of the larger coins, where you could stake them, you could earn interest. Now that new landscape will be that you're bringing in tokens that are tied to real world assets, that may be a physical asset, maybe an ownership of a company, percentage of a company. And so those assets should hold up and be very attractive to investors. And so I just think that it's right from the start of your initial offering and even pre-offering materials, have that, reviewed and ensure its compliance before moving forward, because this can evolve to very, very advanced stages, right from your initial offer. So that's something that to keep in mind. And I did want to address the efficiencies for the institutions just real quickly. We're seeing front, back, and middle office efficiencies, and that's for utilizing the blockchain. And so that's the programs and projects that we're seeing right now coming from the institutions, where they're testing it out. They're doing pilot programs, some on their own blockchains, some on public blockchains, but it's that speed of transaction, that security of the encryption is very attractive. And so we're seeing interest on both sides. David, you're muted. I'm sorry.
Sure. That was a bit awkward. So anyway, I've had a blast of a time, and before we go to the last question, and some final comments, Andrew, do you have any? I'd love to hear what your thoughts are on the sort of the integration of DeFi and tokenization. Is there a room? For me personally, I was obviously, I'm a native DGen. I hold a DGen passport, and one thing that struck me about DeFi is that it's sort of like a house of cards of synthetics built on synthetics. You're staking, and then you're wrapping, and then you're putting, and then you're putting it in another vault, but there's nothing really, that it doesn't resolve to any real world value. So what if we can change that and actually attach revenue streams or real estate or private equity to these really next generation financial engineering technology?
When it comes to DeFi as it relates to digital securities, we're ways away. There's still a lot of infrastructure that's just not there. Just the tax reporting components required by it are so wildly intense that that hasn't really been solved yet. There are a couple groups that are approaching the more institutional DeFi side of it. I do believe institutions will figure out DeFi first, mainly because they have the bandwidth and the cognitive capacity to work through things like the tax frameworks, the legal jurisdictional stuff. So they'll unlock it first, and then they'll figure out ways to let that trickle down in a usable, consumable fashion to the retail market. Like there's a company actually out of London here called TrueFin that's doing a pretty good job at approaching institutional DeFi. So I would probably look to it there first, but there's a long way to go. It is extremely complex, and frankly, there probably needs to be some legal framework changes also that will just make it a little bit more acceptable. I mean, when you look at DeFi, I mean, the future of exchanges really separates into two buckets. You're going to have full banking KYC level exchanges like what we're doing with INX and like Citadel and those guys. That will be one side of the fence, and then the other side of the fence where you will have DeFi exchanges. DeFi will exist, but it will be DeFi with some level of like an OFAC wallet blacklisting component. And then everything in the middle, all the kind of gray area exchanges that exist now, will start to either have to modify themselves into one of those two buckets, or they'll just be too high risk to participate in at scale. So that's where inevitably where those two industries, where that industry falls, is really in those two buckets. But again, as we look more and more at the DeFi side, if you really wanted to run DeFi at scale using traditional securities, it is just a regulatory and compliance nightmare with the current tool sets that are available to everybody.
Yeah, for sure. I mean, we were talking today in our neighborhood WhatsApp group about REIT-based tokens and the tax implication of that. So you have, so many new financial primitives, and, is it capital gains? Is it income? Does it matter who you are as an investor? So, I mean, the SEC is only kind of catching up to ICOs now. So until IRS, SEC, until they really get behind this whole DeFi landscape with the difference between maybe a staking and a yield vault, and there's a lot of discrepancy there. So I definitely see
it gets worse than that. You start evaluating what gas actually is and how is gas looked at. Can gas of a security be also considered security? How is that distributed? It is a rat's nest of complexities. Yeah. It will get solved. Just like everything else that we've done that everyone thought was too impossible, inevitably will get solved. But as we're pretty close to the rail on it, and it's going to just be a little while, and you just need a number of smart people spending some time and money to make it happen.
Yeah, if gas isn't looked at as an expense, then a lot of 2022 NFT traders are in a lot of trouble. Mm-hmm. But that's neither here nor there. For the end of our session, I wanted to get your guys' take on the future, medium to long term. Where do you think this tokenization of startups is going? Because we haven't yet seen, a match getting lit under the industry, and we haven't seen the kind of volume of interest that ICOs had. So, what might be the trigger to unleash that in the short to medium to long term? And what are your plans personally as part of your companies to get us there, to kind of accelerate that adoption?
Everyone
at once, yeah.
Yeah, I think that certainly the climate is lending itself to the broader adoption from startups to turn to this as a more than viable option. Because the credit has been crunching here in the U.S. and banks have been really tightening down. There's not as much liquidity to go around, and so I think the move to private markets will be just very clear and apparent, and that is both in a short and medium term, and then I think that that will just become more frequently done now in terms of accessing private capital that has also been sort of reserved for more of the accredited folks and things like that. But I think we're going to see that broadening out to retail investors, bringing those resources together, particularly for smaller, medium-sized projects, and I think that will be what will give startups and founders the leg up into the future and the capital that they need to grow and scale. So yeah, I think it's I think the times are here now, and I think there will just be more volume coming into the space in the very near future.
Yeah, I agree with you, Anthony, but I also hate to say that I think the industry needs to focus on UX, UI, and education. I think especially security token offering industry is very, in the public opinion, very close to crypto. and all the speculation in crypto, which makes the adoption of security token offerings a bit slower than if crypto would had a very good, or if people would see crypto as something good and something you can earn money on. And now most people unfortunately have lost money on their crypto if they enter the market in the last bull run. So I think it's a public opinion thing. It's too related to crypto. Security offering is something else, and it's a way of making the real economy more efficient. And how do we educate people on that, and how do we build applications that people think is easier to use than, for example, AngelList or other crowdfunding platforms?
Yeah, I think everyone's saying basically the same thing here, but it's just still early. We're still early in the process. We need more infrastructure in place for this to be viable. And one of the things I always say all the time is the reason you haven't seen security token space really explode out is if you want to touch and be able to be involved in the security token space, you need to work with like 5 different vendors. And if you needed to work with 5 vendors to buy an iPhone, a lot less people be buying iPhones, right? So the more aggregation we can see, the more integrations we can see, the more seamless and frictionless those processes can be, where users don't have to worry about maintaining passwords across a bunch of different vehicles and a bunch of different enterprises, a bunch of softwares. That's what we need in order to get this done. It's a huge initiative here at Republic, and I know that Tokenwise, INX, and everyone's driving that same direction. So I'd just say stay tuned, but big things coming, especially within the next 12, 18 months.
All right. Thank you for that, Andrew, Anthony, and Sander. I mean, that's why these conversations are so important. They're not just about some guys shooting the breeze, but they're also part of this aggregation of minds, aggregation of companies, of teams, of ideas, of products, in order to get, security tokens tipping point to that much closer. Thank you, gentlemen, so much for your time, your expertise. We'll definitely see you in the future on our shows, our spaces, our webinars, and it's just really, I had a really great time chatting to all of you.
Thank you as well, David. It's a pleasure meeting everybody, and we'll see you very soon.
Thank you so much, David.
Good.
Thank you. Take care.